Hey everyone, welcome to Professor FinTech. Quick question. Have you ever looked at an accounting textbook and thought, what on earth is ledger? Or maybe you have heard words like debit, credit, balance carried down, and your brain is just switch off. I get it. I have been there. These words sound scary, but here's the truth. Ledger accounts are actually super simple once someone explains them the right way. And that is exactly what we are going to do today. By the end of this video, you will understand ledger accounts so well you could explain them to a 10-year-old. We have got real life examples. A bakery called Sarah's Cakes, quizzes, a steep step-by-step walkthrough, everything you need. So smash that like button right now to show your support and let's dive in. So here's what we are going to cover today. And I want you to follow along with me. Okay, first we will answer the big question: what is a ledger account? Then we will break down debit versus credit, the two most confusing words in accounting, using a really simple analogy. After that, we will look at the T account format, which is literally shaped like the letter T. So that's already easier than you think. Then I will show you why ledger matters so much in real business and walk you through how to post entries step by step, and finally how to balance a ledger account. Oh, and there's a quiz side coming up. Don't skip it. It's going to test what you have learned. Drop your answer in the comments. I read every single one. All right, let's start with the most important question: what is a ledger account? Okay, here's how I want you to think about it. Imagine you are running a small bakery. Let's call it Sarah's Cakes. Every single day, money is moving around. You are selling cakes, buying flour, paying rent, taking out a loan, paying your staff. Now, if you try to keep track of all of that in one big messy list, you would go crazy. Nothing would make sense. That's where ledger accounts comes in. A ledger account is basically a separate page or a separate record for each type of money movement in your business. So Sarah at her bakery would have a cash account every time money comes in or goes out of her cash register, a sales account every time she sells a cake or croissant, a rent account every time she pays rent for her bakery space, a salaries account every time she pays her bakers. Each account keeps track of just one thing. That's it. Here's the official definition, and it's actually not that scary. A ledger account is a record that organizes and summarizes all transactions related to a specific account. Think of it like a personal diary, but instead of writing about your day, it records every single time money moved in or out of one account. And here's our first audience activity that I want you to pause the video right now. Yes, pause it and think of three accounts you would expect a small shop to have. Go on. Pause. Think. I will wait. Great. Common answers are cash, sales, rent, electricity, salaries, equipment. If you got any of those, brilliant. Drop them in the comments below. Now that we know what a ledger is, let's talk about the two words that confuse everyone when they first study accounting: debits versus credit. These two words have genuinely confused people for centuries. And honestly, the confusion usually comes from how banks use them, which is the opposite of how accounting uses them. So if you have ever been confused, it's not your fault. Let's sort this out once and for all. Here's my favorite analogy. Imagine a water tank on your roof. When water flows into the tank, that's a debit for your water account. When water flows out of the tank, that's credit for your water account. Make sense? Water in, debit; water out, credit for that specific account. Now in accounting, the rules looks like this. Debit side, the left side increases assets, things you own like cash, equipment, buildings; expenses, things you spend like rent, salaries. Credit side, the right side increases liabilities, things you owe like loans, creditors; equity, the owner's share of the business; revenue, money earned like sales. Here's a little trick that helped me remember this. Dividend, DEAL. Dividends, expenses, assets are increased by debit. Liabilities, revenue, equity are increased by credit. DEALER. Like you are making a deal with the left side of the ledger. Let's go back to Sarah. She buys $500 worth of flour, paying cash. What happens? Her cash account decreases by $500, so cash gets a credit of a $500. Less cash is equal to credit. Her supplies account increases by $500, so supplies gets a debit of a $500. More supplies is equal to debit. And here's the golden rule of accounting. For every debit, there must be an equal and opposite credit. Always, no exception. This is called the double entry system, and it's been keeping business honest for over 500 years. Okay, quick mental check. If Sarah receives $1,000 cash from selling cakes, which accounts gets debited? Cash or sales? Think about it. I will answer that question in the quiz slide later. Before we look at the ledger format, let me give you a quick overview of the 5 types of accounts you will find in ledger system. Think of these as the 5 drawers in Sarah's filing cabinet. Each drawer holds a different category. First, asset, things the business owns, cash, equipment, inventory, buildings, these are the good stuff. The second, liabilities, things the business owns, bank loans, money owed to the supplies, these are the obligations. Third, equity, the owner's stake in the business, their initial investment plus profit minus withdrawals. Fourth, revenue, money earned from selling products, providing services, interest income. Fifth, expenses, money spent to run the business, rent, salaries, electricity bill, marketing. Assets and expenses increase with the debit, liabilities, equity and revenue increase with the credit. Remember the DEAL rule. Now let's look at what the actual ledger format looks like. This is probably my favorite slide in the whole deck because it's so satisfying. Once it clicks, the ledger account is formed as what accountants call a T account. Literally, the shape of the letter T. At the top of the T, you write the account name, for example, cash account. The left side of the T is the debit side. The right side of the T is the credit side, and inside each entry has a 4 columns. Date, when the transaction happened, particulars, a brief description of the other account involved, folio, a reference number to the original journal entry, account, the value in dollars, whatever currency you use. So let's look at Sarah's cash account. On the debit side, we see January 1st, she invested $5,000 of her own money into the business. January 5th, she made $1,200 in cash sales. January 10th, she took out a $3,000 bank loan. On the credit side, we see money going out. January 3rd, she paid $800 for rent. January 7th, she spent $500 on supplies. January 12th, she paid $1,500 in salaries. Makes sense? Alright? The left side shows where cash came from. The right side shows where cash went to. This is literally how every business in the world tracks its money. Big corporations, small shops, everything all uses the same simple format. Here's a task for you. Try creating a T account for Sarah's sales account right now. What entries would go on the credit side? Write it on a paper or in the comment. Quick question, what's the difference between a journal and ledger? Because these two often get mixed up. Here's the simplest way to think about it. Your journal is like a raw shopping list. Everything written down as it happened in order of a time. Your ledger is like an organized cabinet with separate drawers for each category. All your food in one drawer, all your cleaning supplies in another. The process of moving information from the journal into the ledger is called posting. So the workflow is transaction happens in real life. Sarah sells a cake. It gets recorded in the journal. First with the date, debit, credit. Then it gets posted to the ledger into the right account. The ledger feeds the trial balance, which will create the financial statement. Journal comes first, ledger comes second. Think of it as a two-step process. You might be thinking, okay, this sounds like a lot of paperwork. Why does it even matter? Great question. Here are the 6 reasons ledger accounts are absolutely essential for any business. First, track every transaction. You have a complete record of every financial movement. Perfect for audits, reviews, or simply knowing where your money went. Create financial report. All your financial statements, the profit and loss, the balance sheet are built from the ledger data. No ledger, no reports. No reports, no idea if your business is making or losing money. Prepare the trial balance. The trial balance takes all your ledger closing balances and checks that total debits is equal to total credits. If they don't match, there's an error somewhere. Ledgers makes this possible. Detects error quick because every entry has a corresponding opposite entry Mistakes are much easier to spot and correct. Business decision making. Want to know which product is most profitable? Check the sales ledger. Worried about cash flow? Check the cash ledger. Ledgers give you real insights. Legal and tax compliance. Tax authorities require accurate records. Good ledgers keep you compliant and protected. In a short, if your business were a human body, ledger accounts would be the heart. Everything else depends on them pumping correctly. Now let's walk through the step-by-step process of how you actually post a journal entry into ledger. Let's say Sarah's journal shows this entry. Debit supplies account $500, credit cash account $500. Sarah bought $500 of a flour paying cash. Here's exactly what you do. First, identify the accounts. The account involved are supplies and cash. Steps 2, locate the right ledger pages. Go to the supply ledger page and the cash ledger page. Step 3 is record in supplies ledger. On the debit side, write date, cash account as particulars, folio number, and $500. Step 4, record in cash ledger. On the credit side, write date, supplies account as particulars, folio number, and $500. Step 5, cross reference. In both entries, note the journal page number so you can trace it back later. See how each entry mentions the other account as the particulars. That cross reference is that makes the double entry system so powerful. Every transaction is traceable. At the end of each accounting period, a month, a quarter, a year, you need a balance each ledger account. Think of it like tallying up your personal account at the end of the month. What's the financial balance? Here's the 4-step process. Step 1, total both sides. Add up all the amounts on the debit side. Add up all the amounts on the credit side. Second, find the difference. Subtract the smaller total from the bigger total. That's your balance. Third step, insert balance CD. Write the balance on the smaller side, labeled as balance CD. That stands for carried down. This makes both sides equal, like balancing a scale. Step 4, bring forward. Start the new period by writing balance BD on the bigger side. That's the brought down. This is your opening balance. Let's take an example. Let's do Sarah's cash account. Debit total $9,200. Credit total $2,800. Difference is $6,400. Write $6,400 as a balance CD that is carried down on the credit side. Both sides now 9,200. Next month, start with the balance BD of 6,400 on the debit side. Sarah has 6,400 in cash at the end of the period. Beautiful. Before we get to the quiz, let me save you from the most common mistakes that beginners make. Mistake number 1, posting on the wrong side. Always double check, is this account an asset or expenses? Then debit increases it. Is it liability, equity, or revenue? Then credit increases it. Mistake number 2, forgetting the second entry. Double entry means every transaction must have a debit and a credit. If you post one side, you must post the other side. Mistake number 3, arithmetic errors. Use a calculator, always add twice. Simple mistakes can throw off your entire trial balance. Mistake number 4, using the wrong account. Always refer back to the source document before posting. Don't post from memory. Mistake 5, no folio reference. Always note where the entry came from. It makes auditing and error checking so much easier later. Everyone makes these mistakes at first. The key is to systematic, check your work and practice regularly. Alright, quiz time. This is where you prove what you have learned today. I'm going to give you 3 questions. Pause the video after each one. Write down your answer, then unpause to check. Ready? Let's go. Question number 1. Which side of the ledger do expenses go? Debit or credit? And the answer is debit side. Expenses increases with the debit. They are on the left side of the T account. Remember DEAL rule. What does the term balance CDs mean in a ledger? It means balance carried down. The closing balance that gets carried forward to the next accounting period. Question number 3. A business receives $1,000 cash from a customer. Which account gets debited? The answer is C. Cash account. Cash comes in, Cash is an asset. Asset increases with the debits. You have got it. How many did you get right? Drop your score in the comments. I want to see how you are doing. Let's do a super quick recap before we wrap up. Your 6 key takeaways from today. A ledger account organizes all transactions for one specific account. Debit is the left side, credit is the right side always. There are 5 account types: assets, liability, equity, revenue, expenses. Journal records in date order. Ledger organizes by account, that's posting. Balancing, total both sides. Find difference. Write balance carried down or being brought down. Ledger balances, trial balance, and financial statement. Here's the beautiful big picture. Every business transaction flows from the real life into business transaction, from real life into the journal, gets posted to the ledger, fits into the trial balance, and finally becomes your financial statement like the profit and loss and balance sheet. That's the complete accounting cycle. And you now understand the most important step in that cycle, ledger. And that's it. You have just gone from knowing nothing about ledger accounts to genuinely understanding one of the most fundamental concepts in all of accounting. Seriously, that's not nothing. That's actually huge. If this video helped you, please hit the like button right now. It genuinely helps the channel grow and reach more students like you. If you have any questions at all about anything we covered today, drop them in the comments below. I personally read every single comment and reply to as many as I can. And if you want to keep learning with me, click that subscribe button and the notification bell so you never miss a new lesson. Before you go, here's your homework for today. Create a simple T account for a cash ledger with at least 5 transactions of your own invention. Give it a try. Take a photo and share it in the comments. I will check them and give you feedback. In the next video, we are going to tackle the trial balance, what it is, why it matters, and how prepare one step by step using the ledger balances we learned today. You do not want to miss it. Thank you so much for watching. You have got this. See you in the next video.